Hello everyone, I'm Steve Savant, host of the Business Insurance Zone. Today and all this week, we're talking about tax-free income using life insurance, part of our series on tax-advantaged income. Our non-MEC life insurance contracts, designed to minimize policy expenses, can not only generate tax-free retirement income, but it can also compete and sometimes beat most of the expense loads of similar investments. And with me today and all this week to sort it all out is my special guest, Eric Palmer. He's the National Director of Advanced Sales for Brokers Alliance. Eric and I are going to walk you through the policy expense loads, expose the design flaws of most illustrators, and continue to debunk the myths of life insurance as a legitimate savings vehicle. And remember, before moving forward with anything you hear on the show, always check in with your CPA, your attorney, or your broker-dealer compliance departments. Well, welcome everyone. I'm Steve Savant, the whiz of the biz, and with me today is Eric Palmer, National Director of the Advanced Sales here at Brokers Alliance. Welcome to the show, Eric.
Glad to be here.
We're broadcasting live from Fountain Hills, Arizona, home of America's largest fountain, to a national audience of financial advisors and professional producers. And I want to welcome you to the show. And a little bit of our housekeeping. The Business Insurance Zone is a Bravo broadcast initiative from the National Insurance Clearinghouse, the marketing arm of Brokers Alliance. And it's distributed in HD 1080p all over the internet, I have to say. YouTube, Vimeo, Facebook, LinkedIn, Twitter, and the on-demand section of brokersalliance.com. The show's email address, if you want to write us, is thebiz@brokersalliance.com, or you can call us toll-free, 1-800-290-7226, with any questions or quotes you have on life insurance, annuities, DI, LTC, and group pension. Head up. We're recording this in November, so heads up. If you're doing long-term care, this is the time to do it. We've been tweeting and blogging on it all over the net, trying to bring awareness on Awareness Month, LTC.
Right.
Well, you know, we're talking about this week, we talked about taxes yesterday. Today, we're going to be talking about, I think, kind of controversy.
Right.
Expenses. Every time I hear certain people out on cable television, and she will remain unnamed, or a person that has a national audience on radio, I've never heard such misinformation in my life, but I say, bring it on. Right? Let's talk about expenses today. I will say up front in our show today, if you do not do it the way we're talking about, the way we design it, the architecture, the way we do as an illustrator, professional illustrator of almost 30 years, doing proposals, if you don't do it the way we tell you to do it, you're really not helping your client out. You're actually loading expense loads on, and you're putting unnecessary costs to the contract.
Right.
So
I think what kind of makes us vulnerable a lot of times for a lot of these national spokesmen for other types of investments and whatnot that are out there is just the misuse of products that are built for a very specific application. So again, it's getting to know the different ways to run these illustrations to make them, maximize not just the income that can be taken, but making sure it stays in force, address the issues that we talked about in the Monday show, where you could expose your client to certain things, and also keep the cost down, because we are still trying to present this to our clients in one way as being an alternative to many of their other investments. And so a lot of times that comes down to talking about percentages. What is it going to cost me to have this investment vehicle, and what am I going to get back in return?
Anytime I look at tax-free income using life insurance, I always am going to look at the hold positions, no less. It could be maybe 12 years if you want to cheat the system a bit, but really most surrender charges on contracts are over by the 15th year. And then you've given the contract plenty of time to do its ups and downs, accumulation, take a hit or two in the market, or current interest rate, depending upon what product. We're going to talk about all that tomorrow. Right. But when I'm looking at it, my goal, and we're going to talk tomorrow also on how to illustrate and design these to minimize the expenses, but our goal, really bottom line, I don't want to really be spending more than 100 basis points all in as an average for the year. Now, the front end of what I'm going to be talking about, the front years, the first 5 or 10, I'm going to exceed that. Right. But I'm going to try to minimize it as much so that my average cost for the life of the contract is under 100 basis points. Now, every time I say that, everybody goes crazy. Right. I mean, they go, Steve, how can you do that? Well, there's 4 moving parts that we have to contend with. 3 of them we can pretty much do nothing about. Right. I mean, let's talk about it. Everybody has a policy fee. Right. It could be, well, I haven't seen one under 50 for a long time. I don't know, is there anyone $50? No. It's probably $75, $100 is your average policy fee. They need it to generate, set up the policy. It's just the cost to do business. Right. Okay. So I can't get around that. And now some of these contracts, a lot of them, whether it's current company, current assumption UL, whether it's indexed UL, variable UL, all those are priced in there when I'm looking at, they have front-end loads I might have to pay.
Right.
It doesn't, and it's only for the time I have to pay it as I'm paying premium. Some contracts will allow a reduced, or it reduces as I make premium payments, but it's a cost I can't get around.
Right, exactly right.
So when I'm looking at premiums, I'm looking at policy fee, I'm looking at admin charges. Those are things that are fixed that I can't really dicker with.
Right.
I can't really change. What I can change and what I want to change is I want to reduce the cost of insurance, which is the highest expense load, and it just happens to be the place where we can tailor or customize the contract. Now talk a little bit about cost of insurance, and then we're going to talk about how we're going to play that game. I don't want to get into that. We're going to manage that a little bit more tomorrow, but I want to talk about the actual expense loads because I want to compare that to some of the funds that we're up against all the time.
Sure. Well, cost of insurance is going to vary based on the different age of the clients that we're talking about. So things even like underwriting come into play when dealing with cost of insurance, because if we can get our clients to the highest rate value possible, we're not adding to the premium costs that we're putting out in front of them. So it's a factor that's set and differs between every carrier. And we even talked about this sort of offline. How do you determine even an average cost of insurance anymore? Because it seems that there's so many variances out there. But there are ways to keep it under control, and underwriting is first and foremost one of the ways to start there. Another thing is to look at the combination of the individuals that you're dealing with, spouses versus single individuals. Is there a way to leverage the youth in the couple in order to again take advantage of that?
Well, let's just talk about that for a second, because Eric, I don't know if a lot of our listeners or our producers, especially, really, I mean, the good part is I guess women are cheaper because they live longer. The longer the timeline on the client, female clients or female insureds are going to be cheaper. So if I have a male and a female both 45, she might be 38. Right. In male actuarial land. Right. And what I like about that is since most of our non-qualified monies are not having to be placed in a corporate owned or a ERISA owned qualified plan, it's non-qualified. I'm generally going to look at a female. And the odds are, I hate to say this, sounds a little bit discriminating, but I've noticed that females get better underwriting for whatever reason. Right. I don't know why. Their mortalities are better. So the odds of getting super preferred, and I have a female 45, that number right away out of the starting gate, I haven't done anything with the death benefit yet. I'm just saying, just choosing the right person, I've mitigated the costs immediately.
And there could be some hesitation to want to approach that scenario. I know, I think that we're a culture now that's a little bit more conscious of marriages aren't lasting like they used to, and there's always that element of question with a lot of times when dealing with spouses. Are we going to be together? Do I want to put all the onus through my spouse to control the income or be the insured or what have you? But it's important to know that there's specific trust planning that you can do. There's ways to mitigate against that type of a risk. So we have that knowledge here at Brokers Alliance, and if you're wondering if that's going to be a factor, don't. I say put that on the plate. Take advantage of the younger, possibly the female, because the income is significantly different between the two.
Well, heads up, everyone. It could be 35 basis points rate of return if you choose the wrong gender. You don't get the best underwriting. I mean, there's numbers here.
Right, exactly right.
So I want to be able to choose not only the right gender, and 99% of the time it's going to be female. She's going to have a better chance of getting a better offer, and of course I'm always talking generally non-smoke, right? Because I really want the numbers to be as low as I can. Now that's just the selection of who's the insured. We haven't mitigated any of the death benefit play here. Now, heads up, and I have to walk you back in a little bit of history here. In 1982, we had to go into a whole new tax code because of TEFRA, last in, first out, first in, last. All that changed. Then insurance was redefined through DEFRA. What's an investment? What's an insurance policy? That all defined that. But then TAMRA came in, and back in the day, for you young people that weren't around, Eric, you weren't around at this time, we could do a single deposit. There was no such thing as MEC, non-MEC, all this. Single deposit into a contract, buy the least amount of life insurance, just enough to call it the DEFRA corridor and call it insurance. And that was the greatest play. Nobody sold annuities like that when you could do this.
Right.
It was just tax-free, transferred tax-free, everything. That was the day. And boy, I got to tell you, sometimes I fantasize and long for those days like that.
Oh, absolutely. And so that's why in designing the illustration, you can control the cost of insurance too. And it's really coming down to how you're solving for the death benefit. A lot of times, we're thinking life insurance, we think of fixed death benefit amounts. So I'm going to show my client a $500,000 contract with, growth for income and so on and so forth. But, not just, fluctuating between how much death benefit or solving for death benefit to squeeze the corridor, but also remembering option A versus option B. So, there's a lot of strategy to squeezing as much income out of the contract as we can. But by, doing that, we're choosing an option B, which could increase your cost of insurance. So again, there's different ways to leverage more income out, but it's going to fluctuate what the cost of insurance is ultimately going to be on the contract itself. So solving for death benefit becomes a big part of the overall plan to keep the cost down.
And here at Brokers Alliance, believe you me, we watch the DEF recorder and we manage to the TAMRA compliant lines. I mean, like you cannot believe. And every carrier now, almost everybody's conscious of this and have worked it into their software.
Right.
So we don't have to worry about this, generally. Back in the day, we had to actually do it ourselves, and that was a little scary. So what we've done is, when we're looking to mitigate the cost of insurance, which is the largest expense load, I'm trying to get it down as low as I can based on the commitment of the client, how many premiums, because that's going to dictate, to your point, am I going to use level death benefit or am I going to use increasing? Now, it sounds to a lot of listeners counterintuitive. Well, increasing death benefit, you're covering your premium plus your cash. That sounds like it's more expensive. But if I actually buy the least amount of life insurance, the actual cost of insurance for option B, or in my language here, increasing, may be less than level.
Right, and what we talked about again on the Monday show is trying to put the policy in a position also to stay in force. So by using option B and leveraging out maybe a level death benefit later on, we give the policy enough time to allow the cash value to mature so we can accomplish the income goal, but also to leave enough left over so that we can drop down that death benefit, squeeze it out level to age 121 if we can, and make sure our clients are in a position to avoid that large tax bill that could come if you don't do it right.
We're going to manage all of what we're talking about right now. We're going to manage that into the ground on Thursday's show. So I want you to think about, don't forget to watch that show, because if you have your own software at home, we're going to walk you through some of the concept ideas. As an illustrator, you could be a proposal person just like Steve, the veteran. For 30 years I've been doing these illustrations. I feel like we finally figured it out. Well, remember, you can download and view this entire series and our white paper out at www.maxretirementreport.com, as well as the Tax Advantage series that's out there as well at www.brokersalliance.com/tax advantage products. You're listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. When we come back, Eric and I are going to also talk about the expense loads of competing investments to be fair. I just want to take a moment between our segments and talk to you about, if you're looking for new ways to expand your practice, tax-advantaged income strategies could be a game changer for your business. With everyone projected to live longer and taxes expected to increase, tax-advantaged income strategies for retirement will become the most important component for savers and investors. At Brokers Alliance, we've designed tax-advantaged income strategies using annuities and life insurance. From annuities with income riders to medically underwritten SPIAs. From participating whole life to current assumption or indexed UL, we have the concepts the consumers are looking for. These are tax-advantaged income strategies that can generate more net spendable cash in your client's pocket than conventional concepts currently used by professional planners. You can view and download our white paper and the tax-free video series at www.maxretirementreport.com, as well as our Tax Advantage series at www.brokersalliance.com/tax advantage products. Well, welcome back, everyone, to the Business Insurance Zone. I'm Steve Savant, your host, insurance columnist, financial color commentator, and interviewer extraordinaire. And with me, of course, is Eric Palmer. Eric, we've been talking about tax-free. And before I go on and really get into our tax-free, I want to read our caveat just to cover our little E&O backdoor. How's that? Is that nice? Remember, and why do we have to do this? Because I just want to make sure that everyone understands there's a lot of rules and regs, and I've tried to distill it down to the most, what can I say, tight disclaimer that I can and still make sense out of it. So let me read it to you. And remember, our caveat on tax-free retirement using life insurance: the life insurance policy must be designed as a non-modified endowment contract. The contract must be kept in force for the life of the insured. If the maturity date of the contract does not contain a maturity date extension provision, the client should be notified in writing in the application and initialize it. During distributions, any withdrawals of basis or policy loans of gain must comply with the force-out rule, the guideline annual, and the guideline single rule, as well as the cash value accumulation test if you're using CVAT. Now, heads up, I just want to bring this up to you. I use a box in the application. It's there for miscellaneous, just in case you want to add notes. I tell them this is supplemental income. We're going to be looking to take withdrawals to basis and policy loans to gain, or depending upon what distribution format I'm going to use.
Right.
I'm putting it in there, and if I see a carrier that we're using and I'm afraid maybe that client might outlive the maturity date, I want the client to go, heads up, you may want to look at another contract. If you have a huge family history, it looks like you really have longevity, your LE and all your aunts and uncles, everything's long. I just want to be cautious,
right,
and say, hey, maybe I ought to put that in there and have them initialize it before we get going.
Sure, and when we get into talking a little bit more about products, I think in one of the other shows that we're doing this week, we'll identify those products that would come across our desk and we would say, you know what, this isn't the right option, versus the ones that would provide the longer or the longevity for the client. You know.
And remember, we have these incomes side by sides. Insmark does a great job like that. By the way, it's a shameless plug right there.
Right.
And we can compare different types of funds, qualified or non-qualified, but more specifically, mutual funds, because generally the funds, the people that are our detractors on life insurance are generally going to these fund issues. Now, we have our expenses. I think in the first segment, I was very honest about the 4 moving parts, right, the largest one being cost of insurance, and I tried to mitigate that cost. And on Thursday's show, we're going to tell you exactly how we're going to do this, and you'll be able to order any of the illustrations at 1-800-290-7226, our extension 147, and our marketers will just send it to you and show you all our examples. But I want to talk a little bit about their expenses, right? I mean, let's do the balance sheet here issue. Now, I'm going to exacerbate my argument by using, listen to this, the lowest fund out there. It's a no-load fund. Their total expense ratio is 0.21, 21 basis points. I told you I'm trying to stay under 100. They're way down. Now, that is the best. Hardly anybody does it at this level. That's really low.
Right.
They don't carry 12B trailers. By the way, heads up, a lot of funds do. And they don't have commissions. It's completely no load, but a lot of funds do.
Right.
So I just want to remind everyone that I'm always looking. I'm looking at these. I'm looking at trading costs. There's another one that never seems to show up. Trading costs.
Right.
You know, it's in the actual prospectus. You can read it for yourself, but the actual costs are going to be netted. So when I see the regular load, I have to figure out, well, what's the expense ratio? What's the front end comp load?
Right.
Do I have 12B trailers going on? Do I have trading costs?
And all that information is available to your client, but it's so buried beneath the materials that they receive about these retirement accounts, they don't really think about them. You know, I try to find my own and the mutual funds that I personally like to manage, and I think a lot of people are in a position that I am. You know, with all the online trading capabilities, you don't think about those fees because they're buried on a page you never visit on the site. So you could be carrying 25 basis points or more in additional costs there alone and not even realize it.
Well, and remember, some people even have servicing fees for funds under 10,000 contributions. So you start stacking that on. And remember, I haven't even talked about the advisory fees.
Right.
I'm just talking about basic ideas. So even if I was using, like in this space, my expense ratio of 21, that's going to beat my number.
Right.
I'm just going to frankly say that. But I'm going to pick it up on the tax issues all day long. But let's just say, but most funds, the average is not, the expense ratio, the average fund is not 0.21. The average fund in America, at least present day right now, is about 1.15 all in on the expense ratio. Again, that doesn't include if the fund has 12B trailers. It doesn't include trading costs.
Right.
It's in the prospectus, but that number hasn't been factored in here.
And that number is also taking into account that you're personally managing those accounts. You're not paying for somebody to actively manage, and we got to remember that mutual funds are investments that can take a loss. And if you're not paying attention or actively managing those types of investments, you lose a significant portion of your retirement. So that's a bare bone cost if you're doing it yourself. And most people out there have a 9 to 5, and they don't have a lot of time to spend watching the market and watching their own retirement accounts. They're working. So even at that bare bone cost, you got to be all in invested personally to manage that account. So That's the minimum layer, even in my point of view. Even though it's kind of that average higher cost, you're still not taking into account anybody doing the work for you.
Right, and remember that if the average cost of an investment, I mean, I'm looking at these RIA, Registered Investment Advisory Fees. Now, it has went down over the last 3 or 4 years just because the market's just pushed everybody down that line.
Right.
It's still sitting at an average. It dropped from about 1.11 in 2007, and now presently it's about 0.9. So I got 90 basis points on my advisory. I got 1.15 in on my expense ratio, and on top of that, I might have 12B trailers. I might have trading costs. Right. I have other ancillary things that are hard to find. They're in the prospectus, but if I ask for the all-in net, which is what I'd want to know. And of course, if you're dealing with any funds that are M&E charges, if you're looking even in comparing to our funds,
right.
I keep looking at these numbers and I want to see the all-in effect. Now, our goal is to get under that number, right. Whatever it is the average or below that. So our goal is to get the expense load so trimmed down that I can not only compete heads up, because I know I'm going to win on the tax issue. And by the way, just a little side mark that I didn't bring up yesterday. I noticed one year, and this was a tragedy for me. It was the Black Monday. It was back in October of '88. I remember my mutual funds got killed like everybody else in America. I came and I had non-qualified monies in funds. And so in January, I received my statement. And there was my statement. It said I had a loser fund. I lost money. It was a bad day in October, and I didn't get it back in 60 days. So at the end of the year, I looked at a loss. And then on top of it, 4 days later, I got a 1099 for capital gains because they were trading inside. And so I was naive at the time, and I called my investor up, my registered investment advisor. Hey, what gives? How can I have a loser fund that doesn't make any money, and I got a 1099 for capital gains? He says, well, you don't understand. There have been trading, and they're making gains inside the fund itself, even though the end of the year looked bad.
Right.
I didn't get that.
And that all adds up.
Yeah,
so at the end of the day,
up.
After ordinary income tax is taken into consideration, because we know we can address that issue, these charges all add up individually. And when you start comparing them side by side to life insurance, and I had mentioned in a previous episode there about Lincoln Financial, they actually have a component in their software that will compare brokerage accounts even, or mutual fund accounts, and break it down to the point where not just showing what the rate of return, or if you want to, apples to apples, both give them a 4% return at the end of the year, but breaking down the internal charges in the two components too. And when you add it all together and put it on in front of your client, you're going to have a significant story for the life insurance.
If it's done correctly, and again, remember, I can't underscore this any more than Eric and I are doing right now on the air, because it's tragedy. Most of the stuff that we see is terrible. Right. I mean, death benefit way too high. The comp that's being tied to it way too high. We're looking to try to mitigate the cost so our client has the best possibility of taking home real returns and tax advantaged. Right. So it's really important. But what I'm trying to do today's show is to lay out our expense loads and the expense loads of popular people that are on radio and television that are usually not very happy about life insurance. They're kind of negative on us.
Right.
But for us who are purists, who are trying to always lower the expense loads in every way possible under the code and doing it compliant, I really feel like I can compete pretty much once I take the all-in inventory of some of these funds. And I'm not even talking, I haven't even got to REITs, right? Or alternative investments yet that have their own expense loads. So I believe if we were able to spreadsheet everybody's expense loads the way we do our proposals, and whatever investment, whether it's real estate REITs, whether it's mutual funds, and even EFTs, which are a really pretty good deal for America. The EFTs are a good deal. Right. But if I looked at those total all-in costs, remember, again, I'm not talking about taxes yet. I'm just talking about today's show, expense loads. I can fare very well, and some of the good contracts are in the United States. And I have to say, we look at so many. We're going to be talking about this tomorrow. What chassis should you use? Well, I don't know. We'll have to tell you what the game is, and you tell me. But when I look at the expense loads, and I'm trying to say, is it comparable? I can compare almost against everybody for the lifetime ownership of any fund. Bottom line, if you let me do the math. Right. And we're going to be doing it at the lowest possible. We're going to design it so our expenses and our costs are always as low as I can make it under the code.
Well, and I think that's a good way to start thinking, if you're not already doing it out there with your current practice, is start thinking about the all-in number And at the end of the day, what is the goal? Are we going to die with this, or are we going to use this for income? And that establishes your timeline. And so if we understand what our all-in numbers are in these contracts, and you can truly compare the alternatives with your client and get their focus away from the fancy rate of return percentage interest rate that the investment comes with, and start paying attention to what's it going to end up when it hits my palm, how much money is going to be left over, and how long am I going to have it for? And that's where life insurance and annuities really then just hit the home run.
Now let's just really, while we still have time, when I'm looking at expense loads, like let's say I'm going to use an example. This is not the example, it's just a example. Index universal life. If I have a bad boy year and I have a loser year, I cannot lose principal as it relates to the crediting rate. They're not going to credit me negative numbers.
Right.
Whereas on any fund, if it goes negative, it's negative. And you still have to pay the fund's expenses, right? I still have to pay the bill here.
Right.
Life insurance still have the same issues too. I have to pay the bill. So I could, like in our example of the S&P 500, 2001, 2, and 3 straight years that were loser years.
Right.
I still would have to have paid my expense loads on my indexed UL. I can't get away with that. But if you designed it the way Eric and I do, and many of our illustrators here at Brokers Alliance, you would have mitigated those numbers way low. I mean, they would have been down very low compared to some of my mutual fund counterparts and some of my REITs and some of my alternative investments.
Right.
They lost, and I still had to pay the bill. At least I stopped the bleeding using index. That's just one example.
Exactly.
Well, I just want to remember, everybody, I want to try to be as fair as I can by measuring the expense loads of a lot of the investments we compare it with, and we can do that again. Lincoln National is one of those software packages that actually lets us do that. Remember, you can watch our show and read our white paper at www.maxretirementreport.com, as well as go out and see the Tax Advantage 5 video series recorded last month at www.brokersalliance.com, Tax Advantage Products. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.